Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Here's what we're watching most closely in the financial markets. First, the month of May showed a continued split in the performance between some of the largest tech companies in the index and what's happening in the rest of the market. So while the S&P 500 stayed flat as an index, that was really carried by a small number of tech companies that continued to appreciate in value. Most of the remaining sectors showed a decline, which has been happening for several months in a row now, and tells us that we're in the late stages of this economic cycle and likely headed into a recessionary market. When we look at this, we want to focus on the valuations in these other sectors, and they're not quite cheap enough yet for us to get excited about valuations. So we're going to continue to keep a close eye on it, but it's not at a point where we think it's time to take action. One thing we do anticipate is that the Federal Reserve is going to keep the short-term interest rates higher for as long as necessary to really slow down the economy and bring down the inflation rate. The reason why is this chart here, which shows the spike in interest payments that the U.S. government is having to pay on the treasuries that they've issued. You might think when you look at this chart that it means they have to cut rates right now to get back to a more normal level, but that risks accelerating the inflation rate again and them having to raise the Fed funds rate all over again, much like they did in the 1970s. We think it's more likely that they're going to try to keep rates higher for as long as they can to ensure a recession and a slower inflation rate. And because of that, that's why we're defensively positioned, because we think it's inevitable that stock market valuations will come back down to a more normal area and that long-term treasury rates will come back down to what you saw a couple of years ago. Company management teams are starting to prepare for that kind of environment, and you notice it on their earnings calls. In the last few months, they've started to switch from talking about the inability to fill open positions and high labor costs. Now they're talking more about job cuts and cost efficiencies. They see that their revenue growth is starting to decelerate, and they have to find efficiencies in their cost base to try and maintain their profit margins and a similar amount of earnings per share. This tells us that the unemployment rate, which has stayed low for quite a while, is likely going to start heading up in the quarters to come. You're starting to see this in consumer activity as well. Conference Board has been taking a survey for decades, and two of the questions they ask is asking consumers about their confidence level about their present situation and their expectations about the future. Historically, when the number that they give or the confidence level for the future is much worse than how they feel about their present situation, that tends to precede a recession. And as soon as you start to see the confidence level about the present decline and converge with the future expectation level, that's when the recession has really set hold, and that's what we would expect to happen sometime in either later this year or early next year. You're starting to see it in actual spending behavior. Bank of America tracks the growth in spending on its debit cards and credit cards that they issue to consumers. And April was the first month you really saw a shift to where spending is now in decline versus the same time last year. We saw confirmation of this with retailers like Walmart and Home Depot and Target that were reporting their earnings over the last few weeks, and they almost all reported that there was a further deceleration in consumer activity in the month of April. We would expect that deterioration to continue, and it's also concerning that this deterioration is happening while the inflation rate is still at 5%. So when you have real consumer spending declining by 6% year over year, it makes it very difficult for these retailers to maintain their profit margins. Finally, we want to touch on the housing market. Even though we've seen some stabilization in home prices and the amount of sales, it's still a very unaffordable market for any home buyers out there. This is going back decades, and what it tells us is that to return to a normal affordability level, you would need another 10% decline in home prices and a fall in the 30-year fixed mortgage rate from the about 7% rate you see today back down to below 5%. So we don't think that this weakness in the housing market is going to end anytime soon. Part of that is looking at this chart from EPB Research. If you go back through decades worth of data, weakness in the home market tends to last multiple years, especially when you adjust for the inflation rate. So this looks at the home price index nationally adjusted for inflation. And when you start having a decline like we've had for the past year, It typically lasts anywhere from 2 to 6 years before you see home prices stabilize against the growth in inflation. We're only 1 year into this, so we would expect continued weakness to come at least into 2024. Based on all these variables, the Fed having to keep interest rates high, the slowdown in consumer spending, and the continued expected weakness in the housing market, we want to continue to maintain a defensive posture and watch to see what other things are on the horizon and wait for some better valuations before we really start to get aggressive with our clients' portfolios. If you have any questions about this, please contact us. If you like this video and want to stay up to date on our views about the financial markets, please subscribe below to our Oxbow Advisors channel.